Have you ever seen a company deliver an insanely strong earnings report, revenue up big, EPS surging, cloud exploding, backlog hitting the ceiling, and the stock still gets chopped down by 10%? That's exactly what just happened to Oracle, and after you hear today's breakdown, you'll understand completely. This wasn't a bearish signal, it was something much bigger. Hey everyone, this is Deep Dive Stock Earnings. Oracle just released its fiscal 2026 Q2 results, and the moment I saw the numbers, I knew this was absolutely not a normal quarter. Revenue strong, profit strong, cloud business exploding, backlog numbers so extreme they almost don't look real. But the question you're probably asking is, if everything looks this strong, why did the stock drop 10%? That's exactly what we're going to break down today. Let's start with the numbers, because the numbers alone are already shocking. Oracle reported total revenue of $16.01 billion this quarter, up 14%. Non-GAAP EPS came in at $2.26, up 54%. GAAP EPS hit $2.10, which looks even more dramatic, mainly because of a one-time gain from selling assets. But even without that, performance is still strong, and even that isn't the real story. What completely forces you to reevaluate Oracle is the revenue Oracle has already locked in for the future. Oracle's RPO this quarter didn't grow, it exploded. Total RPO surged to $523 billion, up 438% year over year, and just the backlog added in this single quarter was $68 billion. What does that mean? It means customers like Meta, Nvidia, Uber, and T-Mobile aren't just signing maybe someday multi-year contracts. They're telling Oracle, we need compute now, we need CPS now, we need AI model training capacity now. And the short-term RPO part, expected to convert into revenue in the next 12 months, jumped from 25% growth to 40%. That is one of the single most important numbers in the entire report. It tells you that these AI customers aren't playing around. They need capacity right now. But here's the tension. If orders are exploding and growth is exploding, why did the stock get sold down? What exactly is the market afraid of? To understand the drop, you have to look at the cost side. Oracle's cloud business is growing so fast that the company is being forced to aggressively expand its data centers at full speed. Capital expenditures this quarter jumped to $12 billion, and the result was a single quarter free cash flow of negative $10 billion. And what does the market hate the most? Not losses, but growing so fast that you burn cash too fast. Investors are used to Oracle being a high-margin software company with stable cash flow, but Oracle is now undergoing a transformation. It's not just a software company anymore, it's becoming a massively capital-intensive AI cloud infrastructure provider. If you want to keep up with Meta, Nvidia, Disney, and every other LLM company demanding compute, you simply have to spend. Oracle knows this freaks out the market. That's why on the earnings call, they emphasized over and over that they will maintain an investment-grade credit rating and will start using GPU leasing, customer-provided hardware, and other methods to reduce capital pressure. In other words, the market isn't selling the earnings. The market is reacting to the shock of Oracle turning into the next AWS. So the real question becomes, if Oracle is spending this aggressively, is the business momentum strong enough to justify it? And the answer is yes. Absolutely, because their cloud business is now running at full capacity. Total cloud revenue hit $8 billion, now half of Oracle's entire business. Infrastructure cloud grew 68% to $4.01 billion, and the most important segment, GPU cloud, tied to AI workloads, grew 177%. This isn't a concept story. This is real demand. Uber is using more than 3 million cores. T-Mobile nearly hit 1 million cores during the holiday shopping peak. These customers aren't just signing contracts, they're consuming compute at maximum load. And Oracle's multi-cloud strategy is pouring gasoline on the fire. They brought Oracle databases directly into AWS and Azure, meaning customers don't have to migrate anything. This single decision pushed multi-cloud database consumption up 817%. Then there's another major strategic move: sale of Oracle's chip design company, AER, not because it was losing money, but because Oracle decided to fully embrace Nvidia, AMD, and every other AI chip ecosystem. Ellison's message was crystal clear. We don't want in-house chip design. We want speed. We want scale. We want the fastest possible deployment of massive data centers. And that's exactly what AI is about. Whoever provides the fastest compute at the largest scale wins. So after reviewing the numbers, the customers, and the demand, we still have one final thing to look at: the future. Oracle's forward guidance is extremely important. They kept their full year FY to 0 to 6 revenue target at $67 billion, but because short-term RPO exploded, they raised FY to 0 to 7 revenue by a full $4 billion. That means the money will arrive earlier than expected. Next quarter's guidance is also strong. Cloud revenue is expected to grow 37% to 41%. Total revenue up 16% to 18%. There is no slowdown here. This is continued acceleration. When you stitch all these parts together, you see a very clear picture. Oracle is aggressively taking the prime land in the AI cloud era. The money they're spending, no huge, painful, and shocking to the market, is setting up more than a decade of high-margin future revenue. The market is scared, but the things the market fears the most are often signals of deep structural change already in motion. So, if you want to summarize this earnings report in one sentence, it's this: Oracle wasn't sold because it was weak, it was sold because it was so strong it made the market nervous. Revenue strong, EPS strong, cloud strong, AI demand strong, backlog strong. Only problem is spending heavily to handle explosive demand. Short term, it's pressure. Long term, it builds the competitive advantage for the next decade. This is Deep Dive Stock Earnings, and I'll see you in the next one.